Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of August 2021. Broadly, across the month, bond markets were actually pretty quiet. They've been following on the similar themes of July, being that of slowing global growth momentum, clearly rise in the Delta variant of COVID and the change in mobility. We're obviously very affected by that in Australia, much less so in the Northern Hemisphere, where life is returning to normal, but there's still some restriction and reduction of movement. And some of the geopolitical events, clearly the US withdrawal from Afghanistan, what US power looks like, on a look forward, and some of these Chinese regulatory issues which have been circulating in domestic markets in China. And broadly, they've been quite supportive of the interest rate complex, keeping bonds well sought after through the month of August. As we enter into September, we do get a much larger lift in global bond supply. After the summer holidays in the Northern Hemisphere, we generally see an increase, particularly in corporate bond issuance in both the US and European markets. And that generally will counteract some of those positive type developments for bond yields and bring us back into balance. We expect that we're going to enter a range-bound period for interest rates. But we do note that some of the forward-looking search activity is starting to pick up. So where we've seen this slowdown in momentum and these big decays in things like surprise indices, this forward-looking search activity can be a precursor to a little bit of a rise. And so we certainly hope for that global economies can re-accelerate, because there's plenty coming over the hill, as there always is in this world where we live under such generous policy accommodations that were enacted on the markets to hold back economic hell in March and April of 2020. And clearly in the Northern Hemisphere, we're a long way beyond the peak of those health outcomes. Life, as I said, is returning to normal. People are vaccinated, inoculated. And so as we look forward to 2022, there are a few things to consider. Clearly, as we get towards the end of the year, we spoke last monthly about the Jackson Hole meeting and how that had potential to be a big market moving moment. Invariably, it was actually very, very quiet. The can got kicked further down the road for another day. And since then, we've had some weaker US data with regard to employment, which means that any tapering conversation we might have about the US Federal Reserve buying less bonds under their quantitative easing program is not likely to occur until much further on into 21. But as we come around the corner to 2022, we do have a tremendously large fiscal cliff that I think the markets will start to consider being very forward-looking. And that fiscal cliff in the US, for instance, goes from a deficit of 13.4% of US GDP, quite staggeringly large, down to a number somewhere in the estimates of 4 to 5%. It is the largest single reduction in deficit spending, even larger than that after the World War II period. And that means that there is a huge burden on the private sector to lift its own outputs to close that gap. Otherwise, the US economy can see much lower growth going forward. And that, combined with any kind of normalisation of policy, albeit in a very baby steps format, clearly might give markets something to think about, that have enjoyed this rebound in global growth coming out of the lockdowns of 2020, combined with some of the most generous liquidity provision we've ever seen in markets. And you've seen the way that many asset classes have reacted to that. It is, as we always kind of note, a very fine balance for central bankers. They have this negative feedback loop of their own making. It's a rod for their own back. They have been too good at holding back some of those volatilities in economic outcomes that otherwise would have naturally occurred. And so now, if they are to tighten into a slowing economy, clearly we see the fragility of markets these days, heavily algorithmic. We've seen it in the bond market this year in particular. We saw it in corporate credit markets and equity markets last year, and we saw it in all markets at the end of 2018 when the Federal Reserve had a little overstep at that time and sent markets into a real tailspin. So there's always a lot to think through. We're obviously thinking through those issues. We are noting that inflation continues to fall, although we do believe it'll be stickier for a period. There's still these supply side issues hanging around, which are problematic and keeping inflation rates slightly elevated. But the bond markets are looking through that, expecting that supply will ultimately normalise, as it often does after these bottleneck periods. But yeah, that's certainly what we're focused on leading into September and beyond. Clearly, with our own domestic story here in Australia, this flip from pandemic to endemic in the government narrative, led by New South Wales and now adopted by Victoria, is obviously a very positive thing from a market's point of view. There is a pathway out to quasi-normalised life where we're not all locked down constantly. And so certainly we've kind of seen the currency bounce and a little bit of underperformance from Australian bonds in relation to their international counterparts. We do hope that that stays on track, vaccination levels get up, and we can all enjoy a fairly normalised Christmas. Thank you very much.